I have 90% of my money invested in global index funds. There's a few different ones that I have, but it's £164,000 in total that I have in them. I've invested like this since 2018, and I will be for the foreseeable future, at least for the next couple of decades. Why? Well, from 1990 to 2020, this study here found that 2.4% of all companies from over 64,000 stocks produced all of the net global stock market wealth creation. That's why I use global funds. Video over. No, let me tell you the exact reasons why I invest using global funds, using this study, other studies, and personal experience, what the honest drawbacks are, and ultimately you can then work out whether it's the right investing approach for you. I'm Ryan, a chartered accountant, and I have grown my own investment portfolio using global funds, and I help other people to do the same. Check the link in the description if you want to see exactly how I can help you out with your own investments. Why do I use global funds? I've come up with 9 main reasons. A lot of them are interlinked, and it really comes down to this idea of beating the market. There's 2 schools of thoughts with investing: active versus passive. Tracking the market passively and getting the market return versus trying to pick stocks to beat the market return. In short, the data shows overwhelmingly that passive beats active. This is the Spiva scorecard that tracks this and shows this. So I knew that I want to invest passively, but I also want to be as diversified as possible. As often when you hear people talk about passive investing, they only mention the S&P 500. Why do I want to be as diversified as possible? Well, Japan is the best example of this. This data is from the Credit Suisse Returns Yearbook. Japan made up 45% of the global stock market. Then it didn't produce a return for 28 years. Now it's just 6% of the global stock market. So keeping those points in mind, what are the actual reasons that I use global index funds myself? Firstly, diversification. I can own thousands of stocks from every corner of the world in developed markets and emerging markets, all inside one fund. The beauty of index funds is that you can get this instant diversification rather than buying a share in every single stock. But the fact that these global funds invest into every corner of the world gives amazing diversification. Secondly, as I own the world, this takes all of the guesswork out of my investment approach. Now, that would have meant that I was very concentrated in Japanese stocks in 1989. Had I been alive then and investing, I wasn't. And it now means that I'm very concentrated in the US stock market today. But that brings on to point 3, that these global funds self-cleanse or auto-rebalance over time. This can be shown in the Credit Suisse Returns Yearbook once again. Global funds follow the money. As different countries, industries, and stocks do well or poorly over time, that's automatically reflected in a global fund. Which brings on to point 4, and I did say these points are quite interlinked, but that means I don't need to try and pick winning stocks. I'll flash up the Spiva scorecard once again. Most fund managers simply cannot beat the market by picking winning stocks, especially over the long term, and the same unfortunately goes for individual investors like myself. Number 5, the data really supports this long-term global approach. Best in Binder has a few studies on this. There's the global one that I mentioned right at the start of the video, where just 2.4% of companies out of over 60,000 stocks across a 30-year period actually contributed to creating wealth for global stock market investors. Best in Binder has also done a study looking at the US stock market, where once again found similar results, that a tiny percentage of companies and a tiny absolute number of companies actually generate stock market wealth for us investors. And he recently updated this US study to show that an even smaller concentrated number of stocks over the last 100 years has actually contributed to us generating wealth. Just 46 stocks across the last 100 years have accounted for half of the net wealth created from the US stock market, which is pretty insane to think about when you think over these decades or even a century how many thousands and tens of thousands of companies and publicly listed stocks there are. The fact that so few actually beat inflation, beat a savings account, and generate wealth is just why it's so hard to pick them ahead of time. Those first 5 points are all quite interlinked. The next 4 now are sort of what I've come up with through my own personal experience. Number 6, simplicity. You simply can just invest in a global fund and set and forget. You don't need to do anything more than that. And because of this simplicity aspect, point 7, global index fund investing helps to reduce behavioral mistakes. And this, to be honest with you, is where most people fail with investing and where I've made mistakes in the past. If you just invest using global index funds and ETFs, you're less likely to try and time the market. You're less likely to chop and change your approach. You're less likely to panic sell or overtrade. You're less likely to FOMO in and chase what's hot or what's performing well. I feel like the good thing psychologically about this global approach, and maybe it's just for me, but this is how I find it, if the market is up or down, it's a win-win. If it's up, great, I'm wealthier on paper. If it's down, great, I can invest in the exact same global fund for a lower price. I find that very different compared to individual stock picking and active fund investing, both which I've done in the past, where you're constantly looking at the price, trying to figure out where you want to buy more, where you're going to sell. Global fund investing is just much simpler and you avoid a lot of those behavioral mistakes that investors make. Point A is that they're low fees, relatively speaking, as low as 0.07% all the way up to around 0.23%, depending on the specific fund. Now, that is a very low annual ongoing fee for this level of diversification, where you're getting thousands of stocks inside one index fund. And finally, there's a strong long-term record. Overall, the global stock market generally goes up over the long term due to productivity and human innovation. And as global funds are diversified, self-cleanse, take the guesswork out of the equation, you can slowly grow your wealth over the long term. Now, returns in the future are always uncertain, but investing in this style using global funds has delivered great returns in the past. That are the main points, but there are a few other positives worth mentioning that I see it, once again, just from my personal experience and from my own learning and research. That a natural currency hedge, because you are investing into companies in every corner of the world, those companies earn in different currencies. It saves a lot of time, a lot of stress, and a lot of hassle, because all you need to do is just automatically invest into a global fund every month. You haven't got to read financial reports. You haven't got to stay on top of news. There's much less maintenance required, and I think it's really easy to understand where your money's actually being invested and what your investment approach is, so there's more likely of a chance you're going to stick to it for the long term. Now, you can actually create a global DIY pie where you can get total global diversification for cheaper. But the beauty of it is you can also just use one global index fund. That's the accumulation version, and literally everything is done for you. All the auto rebalancing and all the dividends are automatically reinvested. This approach also takes the home bias out of it, which is more common in the US, but it can also happen for UK investors too, where you have too much of your own money in local stocks. Because a global fund is market weighted, you are always investing efficiently over time. And as those weightings change, that's of course, once again, self-cleansed and auto-reflected in the fund over time. And the final point I wanted to re-emphasize is that I do think it's easier psychologically. There's no need to pick stocks or time anything. As I mentioned earlier, it's a win-win whether the market's up or down, or that's how I try to frame it in my own mind anyway. So I just keep funneling money in and let the stock market hopefully do the rest to grow my wealth over the long term. But before you put all your money into global index funds, you of course need the full picture. So what are the cons? There are actually quite a few cons, and we're going to go through them one by one now. But in my opinion, each con isn't really a con when you dig into it. I am biased, of course, just pointing that out, but let me go through each main con as I see it, and then my own rebuttal for each con. Firstly, global funds are higher fee. That is right. They generally speaking are higher fee than individual country funds. But that's ultimately because you're getting more diversification. You might pay a 0.03% fee to get access to the S&P 500 and then a 0.12% fee to get access to a global ETF such as ACWI. But you're getting a much, much higher level of diversification, which probably will work out well over the long term. So I'm happy to pay those higher fees. It is worth saying, as I already mentioned, you can create a global DIY pie yourself and bring the fees down. And I'll link a video at the end of exactly how you can do that, but then you have to rebalance. You have to know when and how to do it. So by using one global fund and paying a slightly higher fee, it takes a lot of that guesswork and manual stuff out of the equation, and you're getting much more diversification. Secondly, you won't beat the market, and this is often how stock pickers try to downplay index funds in general, including global index funds. But I mean, look at the Spiva scorecard once again. It's so difficult for these fund managers to beat the market, who have analysts working for them. They have access to CEOs. They have millions of dollars going into all of this and they can't beat the market. So what chance do we have? The stats for beating the market, especially over the long term, are just as worse for retail investors like myself. Thirdly, it's not a get rich quick scheme. You're not going to get rich quick overnight by doing this. You could get rich very quick by picking the right stocks and putting a lot of money into them at the right time. But of course, that's very hard. And I do actually find that money made quickly is often lost quickly. And if people do often get rich for a bit of luck through picking the right stock, then they're much more likely to lose it all because they haven't built up that long-term investing mindset. You only get average returns, which is another way that people try to downplay index funds. And once again, this is true. But 2 points I'd make on this: if you compound those average returns 6, 7, 8% after inflation over the long term, that will make you extremely wealthy. And secondly, those average returns are actually above average because most investors underperform the market by trying to pick stocks, by using active funds, by buying and selling often, paying more trading fees. So by actually getting the average returns through a global index fund, you'll actually outperform the large majority of other people participating in the market. You will still experience crashes. There's often this misconception that global index funds make you immune to crashes. If there is a global recession like in 2008, a global pandemic like in 2020, a global index fund or ETF is still going to be negatively impacted. But unless it's literally the end of the world, you won't be completely wiped out because it's almost impossible that 3,000 stocks, for example, in a global ETF will completely be wiped out overnight. If all of those go to zero, we genuinely have a much bigger problem on our hand. Global funds can be over concentrated. As I mentioned, they were in Japanese stocks in the late 80s, and they have been in the US stocks now for a while today. But that's just a feature of index funds. They are usually market cap weighted, which actually makes them efficient. Even though the US dominates the global stock market, is because that's how much they make up of the total global stock market value. The same goes for Japan, the UK. The UK make up 3.5% of a global stock market index fund, roughly, because that's what they make up of the total global stock market value. By using a global fund, you will own thousands of companies, and a lot of those could be junk companies or bad companies you don't want to invest in. To get around this, you can use an ESG global fund. Here is one example. You could also not use a global fund and pick specific countries or industries, but really by not owning everything and by making those picks, that is an active decision. And unfortunately, the more active decisions you make, the less likely you are to actually beat the market and the more likely you are to underperform a simple global index fund. But with global index funds, you do have a lot less control in terms of what your money is actually invested into. The final con, and I actually think the biggest con, particularly if you're watching this channel, you're most likely very interested in investing, is that global index funds and ETFs are boring, which is partly the beauty of it. And to be honest, the more boring you can keep your approach, counterintuitively, the more you're likely to end up with in the long term. But it is boring. If you have a massive interest in investing and researching companies, then you are probably going to want to do more in your portfolio than simply hold a low-cost global ETF. The way to get around this, and actually a few of the other cons I just mentioned about owning junk and having less control, is by applying a core satellite approach to your portfolio, where you have, say, 80% in a low-cost global fund and the other 20% where you try to pick specific stocks and specific themes. But of course, whether you take that core satellite approach and what percentage you apply is completely up to you. They are the cons, and you might disagree with some of my rebuttals. I might be being a bit biased, but I don't really think most of the cons are actually cons. They're just features of investing into global funds. And even with all of these so-called cons, I personally will still continue to invest using global funds every month. 99% of my stock market investments are in global funds, as you can see. And on my total portfolio at the time of recording, about 90% of all of my money is in global index funds and ETFs. I do have a few different ones, as I like to diversify across fund providers, and different funds are available on different platforms, but I genuinely don't think I will ever change my investing approach. Maybe that's a bit ignorant to say, and my opinion on that might change in the future, but I think the only thing I would ever change in my portfolio is when and if I add bonds into my portfolio, maybe in a decade or two once I'm much older. And once again, if I was going to do that, I would most likely just use a simple low-cost global bond fund, apply the exact same approach to my bond investments as I do to my stock investments. I also get a lot of questions about kids. I don't have any kids, but I genuinely think as well, I will invest the exact same way for my kids one day. No investing approach is perfect, of course, But this approach is definitely the simplest way to invest. And I do think because of its simplicity and its ease, it will actually yield the best long-term returns for most people in terms of what actually ends up in our pocket. Not just because of the diversification, the auto rebalancing, and the hands-off nature of it all, but because it helps to reduce or completely remove a lot of the behavioral investing mistakes that we make as investors. The next question is, which actual global fund should you use if you want to go down this approach? So watch this video here next on screen where I rank the most popular global ETFs for UK investors.